Welcome back to WealthIQX, your trusted channel for clear and simple gold and silver market analysis. Today's discussion is extremely important because something very unusual just happened in the silver market, something that most people completely missed. If you don't understand what it means, you could make the wrong financial decision at a critical moment. Over the Christmas holiday, while most people were celebrating and Western financial markets were shut down, the silver market quietly sent a powerful signal. During this period, major Western exchanges such as COMEX and the London market were closed. However, trading did not stop everywhere. In fact, one market remained fully active, the Shanghai Gold Exchange. During this window, physical silver in Shanghai traded at $82 per ounce. This was not a futures contract or a paper promise. It was real. Physical silver changing hands at that price. At the same exact time, Western platforms were still showing silver prices around the mid-$70 range. This created a clear price gap between physical silver in Asia and paper silver prices in the West. This gap matters because it exposes how silver pricing really works. Although silver trades 24 hours a day, price discovery is not equal across all markets. Most of the time, silver prices are set by futures trading in New York, not by physical supply and demand. But when those futures markets shut down, the physical market in Shanghai revealed what buyers were actually willing to pay when they needed real metal. The result was a sharp difference between what silver cost on a screen and what it cost to physically acquire it. This kind of divergence does not happen often, and when it does, it usually signals stress inside the system. Markets do not like gaps, and historically, these gaps are eventually closed, either by prices moving up or prices being forced down. As Western markets reopen, traders must respond to this imbalance. That is why this event has attracted so much attention among serious silver watchers. It is not just about a single price print. It is about what happens when physical demand briefly escapes the influence of paper trading. We are going to clearly explain why that silver price gap happened, and why understanding the difference between paper silver and physical silver is critical right now. This is one of the most misunderstood areas of the precious metals market, and it is where many investors make costly mistakes. Most people assume silver has one single price. In reality, silver trades in two very different worlds. The first world is the paper market, mainly futures contracts traded on Western exchanges. These contracts represent silver on paper, not necessarily real metal changing hands. The second world is the physical market, where actual silver bars and coins are bought, sold, and delivered. Under normal conditions, the paper market dominates price discovery. Large financial institutions trade huge volumes of contracts, often with leverage, and this activity sets the global spot price. As long as confidence remains high and most traders settle in cash, the system appears stable. The problem is that there is far more paper silver than physical silver. Multiple claims can exist on the same ounce of metal. This works only as long as people do not demand delivery. When confidence weakens and physical demand increases, the imbalance becomes visible. That is exactly what happened during the Christmas period. Western futures markets were closed, but the Shanghai market continued trading physical silver. Without heavy paper selling or algorithmic pressure, the price reflected real-world supply and demand. Buyers in China were willing to pay $82 per ounce to secure metal immediately. That price was not theoretical. It was practical. This creates stress when Western markets reopen. A gap between paper prices and physical prices cannot exist forever. Either paper prices rise to match physical reality, or paper selling forces physical prices lower. This moment of adjustment is where volatility increases and mistakes happen. Another important concept here is confidence. When buyers pay a premium for immediate delivery, it signals distrust in future promises. They are saying, "I would rather have the metal now than a contract later." This behavior often appears when supply is tight and delivery risk increases. For long-term investors, this distinction matters. Paper silver may be liquid and easy to trade, but it depends on market structure and rules that can change quickly. Physical silver, while less convenient, exists outside that system. This does not mean one is right and the other is wrong. It means they behave differently during periods of stress. Right now, stress is rising. We move beyond market mechanics and look at the bigger economic forces pushing investors towards silver. Understanding these forces is essential because silver's recent behavior is not happening in isolation. It is closely tied to global debt levels, currency pressure, and growing concerns about financial stability. Around the world, governments are carrying record amounts of debt. For years, borrowing was supported by low interest rates and easy monetary policy. This made debt appear manageable. However, as debt continues to grow faster than real economic output, the system becomes more fragile. Servicing that debt becomes harder, and confidence in currencies begins to weaken. When governments face this situation, their options are limited. They can raise taxes, cut spending, default, or allow inflation to reduce the real value of debt. Historically, inflation has often been the path chosen because it spreads the cost quietly across the economy. The result is reduced purchasing power for everyday people. This environment is where precious metals traditionally gain attention. Gold and silver are not promises made by governments. They are physical assets with limited supply. When confidence in paper currencies weakens, investors often look for assets that can hold value outside the financial system. Silver stands out because it serves two roles at the same time. It is a monetary metal, but it is also a critical industrial material. While gold is mainly stored, silver is actively consumed by the global economy. This makes silver especially sensitive to economic and technological trends. At the same time, central banks are facing difficult choices. Raising interest rates can slow inflation, but increases pressure on debt-heavy systems. Lowering rates risks weakening currencies further. This uncertainty creates instability, and markets tend to seek safety during unstable periods. Another important shift is psychological. More investors are starting to distinguish between nominal wealth and real wealth. A higher number on a screen does not mean much if the value of money is declining. Silver represents real purchasing power because it is tied to physical reality, not financial engineering. Silver's renewed attention is not driven by hype alone. It is driven by logic. Rising debt, currency pressure, and limited trust in long-term promises naturally increase interest in tangible assets. When combined with silver's industrial demand, the effect becomes stronger. This does not mean silver prices will move in a straight line. Volatility is normal, especially during periods of transition. What matters is the underlying trend shaped by long-term forces, not short-term price swings. We focus on one of the most powerful and often underestimated forces in the silver market: industrial demand combined with physical scarcity. This is where silver becomes very different from most financial assets, and where the long-term pressure on prices truly begins to make sense. Silver is not just an investment metal. It is a critical industrial material with unique physical properties. It is the best electrical conductor of all metals, highly resistant to corrosion, and extremely efficient in energy transfer. Because of this, silver is used across a wide range of industries that modern life depends on. One of the biggest drivers of silver demand today is renewable energy. Solar panels require silver to function, and as governments push aggressively toward clean energy, silver consumption continues to rise. Each individual panel uses a small amount, but when millions are produced, demand becomes massive. Electric vehicles are another major factor. EVs use significantly more silver than traditional vehicles because of their electrical systems, batteries, and onboard electronics. As global transportation becomes more electrified, silver demand rises alongside it. This demand is not optional. Manufacturers cannot simply reduce silver usage without compromising performance. Technology and data infrastructure also play a role. Data centers, artificial intelligence systems, medical devices, and advanced electronics all rely on silver. These sectors are expanding, not shrinking. This creates inelastic demand, meaning buyers must purchase silver regardless of price because their operations depend on it. While demand keeps growing, supply tells a very different story. Silver supply is constrained and difficult to increase. Most silver is mined as a byproduct of other metals like copper, lead, and zinc. This means silver production does not respond quickly to higher prices. Even if silver prices rise, miners cannot instantly produce more silver. On top of that, high-grade silver deposits are becoming harder to find. Mining costs are rising due to energy prices, labor costs, and stricter environmental regulations. Recycling helps, but much of the silver used in electronics is lost permanently and cannot be economically recovered. The result is a market where physical silver is slowly disappearing from circulation. When industrial use consumes silver and investors hold physical metal long-term, less supply remains available. This tightening is gradual but powerful. This is why physical scarcity matters. Markets can ignore fundamentals for a while, but they cannot ignore them forever. When demand consistently exceeds supply, prices eventually adjust. We bring everything together and look at what the current situation could mean for silver going forward. By now, it should be clear that silver is not moving because of hype or short-term speculation. It is being pushed by deep structural forces that are reshaping the market. We have discussed how physical silver briefly traded at a much higher price than paper silver, exposing a gap between real supply and paper pricing. We explored how paper markets dominate price discovery during normal times, but how that control weakens when physical demand increases. We also looked at rising global debt, currency pressure, and why investors are once again paying attention to tangible assets. Finally, we examined industrial demand and the reality of physical scarcity. When all of these factors exist at the same time, markets usually become more volatile. Price swings can be sharp, and emotions can run high. This is where many investors make mistakes. They either chase prices aggressively or freeze and do nothing. Both extremes can be risky. One important idea to understand is time horizon. Short-term price movements are unpredictable. Silver can rise quickly and pull back just as fast. Long-term trends, however, are driven by fundamentals. Right now, those fundamentals include limited supply growth, steady industrial demand, and increasing concern about financial stability. These forces do not disappear overnight. Another key point is that silver is not a perfect or risk-free asset. Prices can be influenced by policy decisions, futures market rules, margin changes, and shifts in sentiment. Governments and exchanges have tools that can temporarily calm or disrupt markets. That is why discipline and risk management matter. Silver should not be viewed as a guaranteed outcome, but as a strategic asset that behaves differently from stocks, bonds, or cash. Its value lies in diversification and independence from purely financial systems. For some investors, that role becomes more important during uncertain periods. It is also important to avoid emotional decision-making. Buying because of fear or selling because of panic often leads to poor results. Understanding the reasons behind price movements helps investors stay rational, even during volatile moments. Looking ahead, silver's path will likely include both opportunities and setbacks. What matters most is whether the long-term supply and demand imbalance continues. If it does, silver will remain an important metal to watch. At WealthIQX, our goal is not to tell you what to buy or sell, but to help you understand what is happening so you can make informed decisions. Markets reward preparation, not reactions. Financial disclaimer. This content is for educational and informational purposes only and does not constitute financial, investment, or trading advice. Precious metals prices can be volatile, and all investments involve risk. Past performance is not indicative of future results. Always conduct your own research and consult with a qualified financial professional before making any investment decisions.